So we're talking about the markets close to records. The Dow actually hit an all-time high yesterday. Our Jim Cramer was one of the people saying it's a great sign if you're worried about the AI bubble because the companies that push the Dow to a record, 3M and Coca-Cola, they're not part of that AI trade. Do you agree with that sense that this is signs of a healthy market?
Absolutely. And one of the things we look at is breadth, and this is what we want to see is broader participation, that rotation of the prior leaders coming back and seeing other leadership within that. And this is exactly what you want to see in that we can keep this bull market going.
All right. Do you have concerns about overconcentration? If you really look at some of the big AI companies, it's about a third of the market, like the Mag 7. Is that concentration concerning as we still have a lot of their earnings coming up, including Tesla after the bell?
Absolutely. And one of the things we do agree is that the market is expensive, particularly when you look at those top companies. And so a little rotation, taking some of the money off the top, putting it into some more defensives is probably a good bet at this point, definitely as we're heading into, let's say, potentially a slower growth. Look, I'm still saying keep the trend. I'm not saying sell your U.S. stocks by any means, but certainly some of those companies, particularly when we're looking at really increased CapEx spending, lower profitability, lower margins, that's when you want to be worried and you might want to rotate into some of your more safety stocks.
Okay. So your word of the day is actually defense.
Yes.
So you're saying you want to be defensive, but how do you get defensive? Is it gold, which just had a big pullback yesterday? Is it bonds? I was actually talking to a very notable investor. They believe that bonds are relatively cheap and that it's a short-term trade, actually. You buy the bonds now and they expect the par value to go up quite a bit as we continue to see more economic uncertainty. Which way should you play defense?
So for me, I'm talking defense just within the equities world. I do agree on the fixed income side, but for here, I'm talking about shifting out of some of the more expensive high flyers, your Mag 7, and looking for healthcare, telecom, specifically to really get a little more oomph as we go into this earnings season and into 2026.
Okay. Is the oomph coming from price performance of these actual names that you're going to invest in telecoms or healthcare, or is it dividends? I mean, why would you want to be there as opposed to tech? Because the earnings growth is really coming from tech.
So part of it is they are depressed valuations. So if we get these cuts, that's where you're going to see the increase, like the outperformance, because these names have been so depressed. And then we're just also looking at slightly higher growth. One of my picks, Thermo Fisher, they've been sort of holding around 3 to 4% growth. They're going to report this morning. I really do expect a beat and seeing an increase in that cadence of that earnings growth coming from them. So it's very specific, but I'm looking for companies that can finally get out of their own way, really start growing, and have that competitive advantage.
No, I do have to say one thing. We're looking at Thermo Fisher right now. I know you can't see it, but it trades at about 24, almost 25 times forward earnings. Is that cheap? I mean, is that? I know it's in line with the valuation, but
it has done a really good run. It's getting to mid-price right now.
Yeah, you're looking for low valuation stocks. Okay, I just wanted to point that out.
No. So they have had a very good run recently. So they've got, but look, compared to the S&P 500, we're still just slightly above the average. So again, they're not a deep value stock. But for what they're able to deliver, the consistency of their earnings, this is a company that you want to be in. And it's also well diversified. You're not going to see a lot of the volatility that you would see in, let's say, a biotech.
All right, fair point. Looking ahead, we're going to get CPI later this week. What are your expectations? We had a guest on earlier that believes it's going to come in at 3%, obviously well above the inflation target.
Yep.
Do you have questions about that report, inflation being stickier than expected, and the impact on the Fed? Do you think this market needs rate cuts, or is that just a bonus after really strong earnings?
I think it's a bonus. Whether we need it, look, I would like it. I think everybody on Wall Street would like it, whether they need it. But certainly, absolutely, it could put increased inflationary pressure on the market. But I would love to see some of the longer-term rates come down, see the mortgage rates come down to really help the economy on that end. And if it has to come initially from rate cuts, so be it.
All right. You don't seem to be that invested in the idea of rate cuts. You say it would be nice. So is it simply earnings that are going to keep the market up? Like today, again, we get the first of the Mag 7 members. It sounds like you think the Mag 7 earnings are going to be especially strong.
I think across the board, I think we're going to see really good earnings from the S&P 500. One of the interesting things going into this earnings season is that earnings were actually raised rather than lowered as we hit that September 30th date. And that's unusual. That's an unregular pattern. So I think the expectations are already very high, and the early signs are that we're going to see even more beats, both on top line and bottom line. I think a lot of the growth is going to come from productivity gains. It's not necessarily going to be just your tech companies. I think everybody is going to be able to get a little more efficient as we figure out how to use AI within our companies. And I think the second and third plays are great possibilities going into next year.